Investing is not the most intuitive thing in the world, but if you're watching this video, there's a good chance that you are looking to learn how to begin investing or how to improve your current investing strategies. So stick around, because that is exactly what we're going to be discussing today. How are you guys doing today? My name is Apple, and today we are going to be talking about 5 different ways that you can invest in the stock market. Now, if you're anything like me before I started investing, the stock market seems like some mystical place where a bunch of dudes in suits are like running around, holding up papers and yelling numbers at each other. But in this video, I'm hoping to demystify the stock market and show how very accessible it is to the everyday person and how you can utilize it to achieve your goals. So when it comes to buying stocks, there are really 5 main ways that you can do this. Now, the first way is through purchasing individual stocks through a stockbroker. Now, this is what most people think of when they think of investing in stocks. They think of either calling up a stockbroker or going on a website like Fidelity or E-Trade and picking out a stock, say like Apple or Facebook, and buying a couple shares of that company. Now, this is not the only way to purchase stocks. In fact, it's arguably not the best way to do it either. When you're buying individual stocks, you're much less diversified. If you decide wrong and you pick a company that goes down in value, well, then you just lost some money. So when you're picking individual stocks, these are going to be much more volatile than some of our other options on this list. Alright, so our second option is mutual funds. Now, mutual funds are a collection of stocks that are all lumped together, and you can buy a share of this clump as if it were a stock itself. Now, mutual funds are actively managed investments. This means that there is someone sitting behind a computer deciding which stocks go into this clump and actively rearranging this regularly. So, some people believe that having an actively managed fund makes them better off because they think these people who are deciding which stocks to put into this clump have a better chance of picking right than they themselves do. However, statistically, this isn't the case, and over time, actively managed funds have really performed no better than passively managed funds, which are just clumps that don't change very frequently over time and don't have somebody sitting behind a computer deciding which stocks go in there at all times. So with mutual funds, because there is somebody managing that clump for you, they need to get paid. So they're going to be taking a percentage of the increase in those stock prices for themselves. And this is called an expense ratio. So when you're looking at mutual funds, one of the main things you want to look at is what is the expense ratio. So mutual funds with a high expense ratio means that that person who's managing your money is going to take more of that increase in price of the stocks within than in a mutual fund with a lower expense ratio. So high expense ratio, less money for you. Low expense ratio, more money for you. Alright, so the next way to invest in stocks is through an index fund. And an index fund is another clump of stocks like a mutual fund. However, this one is passively managed, which means there's no one sitting behind a computer needing to get paid and rearranging these stocks for you in this clump. Instead, this clump tracks an entire index. So this could be something like the New York Stock Exchange or the NASDAQ. There are index funds that track both of these stock exchanges. When the stocks in their underlying index increase in value, the index fund will also increase in value. Now, index funds also have expense ratios, but they are usually significantly lower than mutual funds because there is not somebody behind it who needs to be getting paid. And historically, Mutual funds have not outperformed index funds, which means you don't need somebody in there rearranging what you're invested in at all times. You can really just set it and forget it in an index fund. And because the stock market tends to go up in value over time, if you're in it for the long term, an index fund is a really good move. All right, our fourth way to invest in stocks is through a target date fund. Now, these are super cool because they're really just like a one and done investment vehicle. You don't have to worry about investing in other asset classes such as like bonds or like real estate or like gold or cryptocurrencies or anything. You can really just invest in a target date fund and be done with it. So let me explain what a target date fund is. Again, a target date fund is a clump of, in this case, assets. So not just stocks. A target date fund can include stocks or bonds or cash, are usually like the main three elements to a target date fund. So you've got this clump of assets, and each target date fund has a target date. And usually this is the date that you want to retire. So if you're planning on retiring in the year like 2060, there are plenty of target date funds out there for the year 2060. And what you do is you just invest in this target date fund repeatedly and buy shares of this clump of assets. Now, as time goes on and you get closer to that year 2060, this target date fund is going to get rearranged. It's going to switch from a higher concentration of stocks today to a lower concentration of stocks and a higher concentration of bonds and cash as you approach that target date of 2060. Now this is super cool because it lowers your risk as you age so that by the time you are getting closer to retirement, your investment is much less volatile and much less likely to have drastic price swings. So if you're looking for sort of just a really one and done way to make sure your money is working for you and helping you grow towards retirement, a target date fund is a really good option for you because it combines many different asset classes and not just stocks to further diversify where your money is going. And our last way to invest in stocks is through ETFs. So I've mentioned ETFs in a couple videos, but what an ETF is sort of like an index fund, except instead of just tracking an index, it can track like an industry or a certain sector or like a commodity. So again, it's like this clump of stocks that is passively managed, so it's going to have that lower expense ratio, and you buy shares of this clump, but with this clump, what it's made up of is stocks of certain companies or industries. So you could have like an ETF for technology companies, and this is just going to be made up of technology companies. So when the technology sector is booming and profitable, this ETF is going to be increasing in value because it's tracking that industry. There could also be ETFs for like gold, and yeah, if you can think of something, there's probably an ETF for it. So if you really believe in an industry and you want to invest in that industry without having to pick a specific company that you're going to be tying all of your assets to, an ETF is a great option for you because it gives you that diversification while still allowing you to invest in something that you believe is profitable or has a really good future ahead of it. And again, when you're picking ETFs to invest in, make sure that you're choosing ones with low expense ratios. Because honestly, most ETFs are created equal, and you don't want to be paying more for the same service that you could be getting from a different ETF tracking the same exact companies, but that's going to be taking less of your money in the form of expense ratios. Alright, so that's basically it, you guys. Just sort of wanted to illustrate how when you want to invest in the stock market, it doesn't have to just be through individual stocks. You could buy individual stocks, invest in mutual funds, index funds, target date funds, or exchange traded funds. These are all options for you to get involved in the stock market. Each of them has their upsides and downsides. Some are more risky, some are less risky. But really, as long as you have a plan in mind, even if you invest and things don't go your way, you're gonna learn from it, and you're gonna be able to take that knowledge with you into the future and make better investments in the future. So thank you so much for watching. Please like and subscribe if you enjoyed this video. And our question of the day is, which of these investment vehicles are you thinking about using in the future, or are you invested in right now? So drop that in the comments below for a chance to be featured in our next video. And until next time,